Okay. All right, so in the last part of class, we're going to cover, I skipped over, by the way, a couple slides that deal with examples of that transaction costs stuff we were just talking about. And if you wanted to hear more, you could go through those slides. They're just pretty straightforward examples of applying the two approaches we covered. Okay. For the sake of time, we will just keep rolling. Okay, post-closing adjustments. Okay. So now if we're thinking of the life cycle of a deal, we figured out that we were doing a deal. We understood the type of transaction it was. We took an inventory of our deferred taxes that we were inheriting in the deal. We dealt with any weird stuff like goodwill or contingent consideration. Then we dealt with things like NOLs and valuation allowances and FIN 48 exposures. And so in theory, at this point, we got it all right. But now 6 months go by, and we're sitting there thinking, oh man, maybe we didn't get it all right. Because it's very common, right? And if we think of the Lamb Novellus example that was your reading, the Novellus is a big, complicated company, right? And before Lamb acquired us, Lamb didn't know much about us. So it's going to take them a while to find all the skeletons, right? You'd like to think that in the diligence process that everything is discovered, but that's not how it is, right? In diligence, the firms that are helping a buyer and a seller are looking for deal breakers. They're not looking for everything, and so they're looking for the, oh my gosh, you blew this huge tax issue, and that's really going to influence how we negotiate a transaction. They're not looking for the, oh, you never filed a Nebraska tax return, right? That's not going to influence a $3 billion transaction. So if it turns out, as Lamb acquired Novellus, that, oh, they never did file a Nebraska tax return, and that's really a problem we need to deal with, even if the exposure is fairly insignificant. It's still an exposure, it's still a liability, we want to get it on the books, but it might take them a long time to figure that out, right? And so with Lamb, they bought this company Novellus in June. Lamb has a June year end, so they already had one Q4 for their fiscal year go by with this acquisition. They've since had another Q1 go by, and I can tell you that they're still figuring stuff out, right? And that is not a problem. I mean, that is how life works, right? There's nothing wrong with that. So this section of the slides here that we're going to cover next deals with, well, how do you deal with the fact that things pop up later? Okay. Okay, so there's something called a measurement period. And basically within the measurement period, as you find things, you just keep doing purchase accounting over and over again. Okay? And when I say purchase accounting, I mean you account for these new bits of information as if you learned them at the acquisition date, which would normally mean running things through goodwill. Okay? So if you find something 6 months after the acquisition and you say, oh, you might owe a tax authority $1 million for this exposure, well, we're going to credit the liability for $1 million, and we're going to debit goodwill $1 million, as if we knew this on the date of the acquisition when we originally did our purchase accounting. Okay? So as long as you find these things within the measurement period, you get to book them as if you knew them on day one, and you booked them just like you did every other piece of the acquisition. Okay? And the way that the accounting rules work now is, and you can see this language, it's you got to be careful with this language. It says that it's not to exceed 1 year. And that doesn't mean it is 1 year. It just means it can't be more than a year. So if you go out in your first quarter of a deal and say, you know what, I'm done, I know everything I need to know, then it's not a year, it's that quarter, it's over. And if you find something next quarter, then that's a problem for you. So some companies like to look really sharp and say, oh, I'm so fast, I only need a quarter, I don't need any more time. But most companies will say something generic like, I'm not totally done yet. And like I said in the Lamb Novellus example, they make a statement that we're still working on things. Okay? And that's specifically them telling you that their measurement period is still open. Right? If you're a non-tax person reading the financial statements, you don't know what they're trying to say is they're trying to specifically keep this window open, but as a tax person, you know that that's the underlying message. Okay? And what they're basically doing is they're saying that they're basically saying, look, if you found a liability after the fact, if you find it in 6 months, you can credit liability and debit goodwill. If you find this thing in 2 years, well, you're still going to credit liability, but you're going to debit the provision, right? And so you would think that your boss is going to say, you might want to find these things within a year, right? Because we would much prefer the left journal entry to the right journal entry. And so as a tax person, you need to know that, because you might say, well, I'm going to wait until I file my first tax return as a combined enterprise, and then I'll know more. But Novellis's tax return for the date of the acquisition, it's not due for over a year from the acquisition. So it's possible that Novellis won't even have filed a tax return for the period up to the acquisition beyond this measurement period. So there may be no more information that at least you get from a tax return. So you can't take your sweet time if you're trying to get the left-hand side of this example up there in terms of the accounting. You have a year to figure it out. Okay? So, there are other things like, so measurement period, anything that happens within a year of a deal doesn't automatically mean it goes back to purchase accounting. Okay? So let's say, for example, that you had a change to a valuation allowance. Okay? Let's say you buy a company and the acquisition date was here, and within the measurement period, right, this is within 12 months, you decide, you know what, on day one I bought this company and I thought its deferreds were good, I didn't need a valuation allowance, I was pretty happy with the way things were going, but now 5 months later it looks awful, I'm putting a valuation allowance up, their deferreds probably aren't good. Well, that's probably based on information at this date, not really information at that date. Right? So the fact that something new happened based on new facts, just because it's in the measurement period doesn't mean it's a goodwill item. What happens during the measurement period, right? What happens during the measurement period is only meant to be a clarification of facts that existed as of this date. Okay? So if you change your valuation allowance assumptions out here based on losing a big customer or something happening that's really unrelated to the acquisition date, that doesn't make it purchase accounting just because it happened within a year. Okay? Or let's say that Amanda's still at the FTB and there's a liability here for $100, and this company's like, I hope Amanda doesn't catch me. Okay? And then 5 months later, the statute lapses, and Amanda never caught us. Just because that happened within the 12 months, that doesn't mean it's purchase accounting when that liability gets reversed. That's a P&L benefit. We would book debit liability to get rid of our exposure, credit provision for that entry. And we would say that the fact that our statute lapsed is an event that happens here, not here. Okay? So in general, you get a year to fine-tune your assumptions for the facts that existed at the acquisition, but that doesn't mean that anything that happens within a year fine-tunes your assumptions at the acquisition date. There's just events that happen after the acquisition. Okay? So you have a year to fix things, but not everything is fixing Some things are just new events. Okay? So, and this is a commonly misunderstood item, and I'm not sure everyone would even agree with me the way I would say this, but it's the technically correct view. So let's say that you did an acquisition and the acquisition date closed on 4/30/09. This is when you bought the company. That means your measurement period closes a year later. So what if you say over 12 months later, oh, you know what, I totally blew it. I didn't even notice the target had an NOL, right? Which sounds like kind of a stupid thing, but let's just say I didn't even notice they had an NOL. And if I had known, I would have booked a deferred tax asset, right? I would have said, you know, debit DTA, credit goodwill. But gosh, I guess since this is outside the measurement period, I'll just have to book P&L, right? Isn't that a shame? And so that's what you would have gathered from the earlier discussion, right? But if this is an error, right, if you just blew it, then you don't get to book an entry to provision. Just because it's outside of the measurement period doesn't mean it's provision. It just means it's an error it took you a long time to figure out. And so when you book an error, a correction of an error, you still book it the way it should have been booked. You just book it out of period. Okay? So if you're correcting an error, not changing an estimate or changing your facts or whatever, you're just saying, gosh, this was a boot. I should have had a DTA. I should have reduced my goodwill. Nothing that's happened between then and now has changed that other than I figured out that I made a mistake. If that happens outside the measurement period, that's a boot, right? And you should go back and put that entry through goodwill. The problem with doing that is you have to say, sorry, I made a mistake. I should have booked this before. I have to write this memo that says that it's not material and doesn't cause too much heartburn. And then people will slap my fingers, and it's just embarrassing, and no one likes to do it. So this is unnatural to acknowledge the fact that there was an error. But some people kid themselves. This is a very common misunderstanding, that just because it happens more than 12 months later means it's P&L. The 12-month period is there for you to fine-tune your estimates, right? So if you say, well, I didn't know what that 3D2 limit was. I was still working on it. It took me 9 months to figure it out. That's fair game, right? If you just completely miss the broadside of a barn on a fact, that's an error, right? It just is what it is. Okay?
Well, you don't have information at the time to make this determination.
Well, the answer is you should figure it out. Within 12 months, you should be able to get, you know, substantially all the information you need to figure this stuff out. I'm sure there's exceptions to that, but you don't really see them. And where you see them, they tend to be small. Like if Nebraska comes up in 3 years and they're like, hey, you guys owe us some money, and we should have known that, we never booked it, that'll just get swept under the rug and booked as a P&L item. I mean, no one's having heartburn that that's a big error that needs to go back 3 years. So this has to be big and obvious and embarrassing for people to call out errors after the fact.
Like Q4 provisions, and then, you know, is within the measurement period, and then you go on to declare your return, which is out of the measurement period. Is there any other issues as far as like provision to return differences, or is that the same thing with judgment? I mean, whether or not it's actually a provision return or it's an error, it's all the same, or is it?
Yeah, I mean, as a practical matter, these things are a function of their significance, right? If it's small, no one even talks about it. If it's big, then you get creative, right? And you figure out how to manage it, right?
Figure it out to bury it.
Yeah, well, not really. I mean, you just go through all the possible accounting treatments and you figure out which one is the best, and you socialize it with your accounting brethren, and that's how it works. Yeah. Okay, so when you buy a company, you have all sorts of disclosures which are outside of the scope of a normal tax disclosure, right? So,
practical question. You know, you get running a company like, for example, Oracle. Oracle's filing its tax returns, got so many people doing it. And then basically they're starting to move into an acquisition stage. They buy like crazy. They're buying all these companies. Like they buy, you know, PeopleSoft, they buy JD Edwards, they buy Hyperion, they buy, you know, move massive, and you don't got any more people. The point is that, you know, you usually, you know, the poor tax people will say, look, I'm trying to file my tax return. I got my own problems. I'm not going to look at JD Edwards. I mean, I guess what I'm trying to say is, you know, what do they really do?
they hire people to help them.
Oh.
Okay, so we buy a company, we have to do disclosures, right? So if you open up the Lamb 10K, you want to learn, hey, tell me about this deal. What did you buy? How much did you pay for it? What assets did you get? How did you allocate your purchase price? What else should I know, right? And you'll have seen that there's a footnote that just talks about the acquisition, right? The way their acquisition works, I mean, you can see the broad disclosure requirement here. It basically tells the reader, you know, tell me something to help me evaluate the nature and financial effect of a business combination, right? So all those things I just asked, you know, tell me more about those. So again, we talked about this a second ago, but if the initial accounting is not done, if it's incomplete, you're supposed to disclose, you know, the why, kind of the what, the fact it's incomplete, and you're supposed to say, you know, what's going on, what's holding it open. So let me see if I can find the tax language that Novellus was using. Okay, so it's hard to get the screen on this, but they have some language. Yeah, so they have some language right here that basically says, oops, oh boy, now I screwed it up. Well, it's not exactly where I highlighted, but right where I stopped highlighting the we continue to grief. Okay, so you get the idea. Right down here in this bottom section, they say, we continue to gather information for and evaluate these pre-acquisition contingencies primarily related to tax positions that we have assumed from Novellus. If we make changes to the amounts recorded or identify additional pre-acquisition contingencies during the remainder of the measurement period, such amounts will be included in the purchase price and subsequently in our operations. Right? So that's them telling you, I may not be done, I haven't figured out all the tax exposures, I'm still within my measurement period, I'll get back to you. Okay? So that's them satisfying the disclosure requirements. Okay?
Any of these purchase price between the tax and taxes was the last paragraph?
Yeah, sure.
Just look at the tax.
No, it takes into account all sorts of facts.
Where we left off in the prior.
You know, what's interesting about this disclosure in the
Talking about
Lamb 10K is this is them saying, look, I paid $3 billion for this company.
taxable stock acquisition.
These are all the liabilities that I assumed.
I'm buying something
And therefore, these are the assets that I acquired
cash,
with
nothing
goodwill
else on the inside basis of the
being my
asset for
residual.
tax purposes. Okay.
But nowhere in there do you
People
see
do
any
ask,
reference to
"Hey,
any taxes.
Do I really set up a $420
Right.
deferred liability?
So if they booked a deferred tax
The answer is yes.
for, you know, they said they had $1.2 billion of intangibles, there must be some deferred taxes related to that,
So,
right? They don't tell you where,
fact pattern.
right?
and talk about why we need the deferred liability.
And the
Why
the
that
reason is it must be small enough for them to net with
So,
other
in
assets
this
and liabilities,
transaction, we
because they're there.
calculated and said, the book
And they
basis
don't
of
show you any
book
FIN 48
basis
liabilities,
and
even though in that paragraph
book
below they just said there are some,
basis. And
right?
then
But they don't
we're-
show it in this
deferred
table,
tax
and the reason is it must be small enough where they can net it, right? So down in other long-term liabilities of 300 million, some of that will be
The
taxed.
entry that we're going to book
How much? I don't know.
for
Right, you
setting
don't know
up the
either. You
deferred
can't know.
liability is basically debit goodwill
Um,
420. Credit.
so from there,
Okay, increase the
DTL.
DTA details in the tax footnote, see if maybe
Okay,
something.
so that is going to be the entry.
you can
that
potentially see
tax
that from the
person
tax
tell the
footnote,
accounting
because
guys to make.
if there's a large change in deferreds
And is a
that isn't
accounting
deferred
person
provision,
can, understand.
right? Normally
there's
when,
liabilities on the balance sheet.
let me go back here and just write, normally when you see a change in deferreds,
And normally having a
you know, it would
liability on
be
the balance sheet is a good
debit,
thing because that covers a
expense,
problem.
provision, credit, DTL, right? If there was a big increase in deferred liabilities, we would expect the other side of the entry to be
You normally need
deferred
to
provision.
expense something to get a liability
But if
on
it goes
the
through
balance
purchase accounting, right, it could be
don't like
debit,
expense
goodwill,
provision.
credit, DTL.
sheet. So setting up a liability.
And therefore
on
it's
the balance
possible
sheet
for you to look at the
goodwill,
tax
that's like
footnote
the
and see a
nicest
large
thing.
change in the deferreds that elsewhere in the provision footnote
Practical
doesn't
matter, most
equate
people- most
to
readers
an
of the financial
expense.
statements aren't focusing on
Sometimes you can see that.
So for you to be able to get
It's usually
liabilities
hard,
on the balance sheet by
unless it's
adjusting
really
goodwill,
big.
That's kind of like a free pass, right? And this is a very practical statement.
So it's tricky. And when I read the Lamb 10K, they don't tell you much about tax. It's pretty hard to sort it out.
I know you guys.
So it's a good example of what's disclosed in a purchase transaction, but in this case, the amount of detail on taxes is pretty light.
You guys are bucking for participation points.
So one of the other areas that a company will have to add some disclosures around will be their UTB roll forward. And you might remember this from, gosh, probably the third class, where we were talking about UTBs as being the exposure a company has, and the fact that they have to disclose in their footnote what those disclosures are. They have to roll forward that
So
liability.
you don't amortize goodwill. You
So,
just subject it to impairment.
in a situation where you do an acquisition, you know, you might start the year with one balance in your
Normally, if you
unrecognized tax benefit liability or exposures, and finish the year with a different balance. And remember, you're trying to explain how that difference gets from beginning to end of the year with this table. But if a big reason that the liability's changed is because you bought a company that had a bunch of exposures and now those exposures are your exposures, you might call out as a line item, hey, you know what? There's this kind of event here that isn't explained by my normal roll forward descriptions, and I'm going to tell you that when I bought this company, there was this liability that I inherited. And I'm not going to tell you to which country I owe it, or which taxing authority, or for what years it relates to, but I'm telling you when I bought this company, I also assumed 117 or whatever this is million of potential problems.
We will
Okay.
put that entry. Okay.
And so that's a little bit of a it's a little transparency that didn't exist years ago, but now is required by these FIN 48 rules. Okay, so that's another place to look when it comes to
The
disclosure.
accounting guys already reported this stuff at fair value.
Okay.
And so there's no further.
So that's it for acquisitions.
I have a big
So
tax
what I would
rate.
say about acquisitions, and I've kind of alluded to
On
this
net
before,
proceeds of 1,200,
you learn a lot with transactions.
tax basis.
And
So I have
one of the
1,000
benefits
gain.
to being at a firm, honestly, is you see transactions frequently. And so when you see one, you can apply it to the next. Acquisitions, from my perspective, are dangerous when you're working in industry because you may not have worked on a deal for 12 months.
Or-
And then all of a sudden, boom, deal. I've never seen any of this before,
If I want my
right?
balance sheet to balance,
I could get a lot of things wrong. And so I, am empathetic to people in industry that if you haven't seen a deal, boy, you usually see somebody in the provision seat saying, I need to learn, I want stuff to read, give me slide decks of presentations, I want to know what
have a
the
DTL.
other companies do like me that have this situation. They kind of scramble.
Then presumably that would be a
Um,
provision.
So the problem with acquisition accounting and taxes is it's kind of hard to learn, like right in a pinch, right when you need to know it.
No corresponding book income.
You learn things so that you have it in your toolbox,
Right.
but you really learn this stuff through
Avoiding
experience,
looking at
because
provisions
it's
spent.
pretty
That
abstract,
could
right?
be
And so as you're
beyond
learning this
provisions.
stuff from a book, it's tough to sit and know
So
how
I
and
like
know how to
that
apply it. But
whole,
once you've seen it in the real
detailed
world,
concept.
you tend not to forget it. And with acquisitions, like I was saying earlier, the numbers are almost always big,
That future tax
right?
event, basically already covered.
So,
It's just
unlike sometimes in a
converting
provision where
deferred
things are
liability
immaterial or you
to
blow
current.
things off, that is not the case typically with acquisitions.
If I
Usually
don't
you
set up
get
those
it right.
liabilities, I'm
I
in
mean,
trouble
it's
in the
important
future.
not
That's a big
to
problem.
not to miss things.
Okay, so does that make a
Okay,
little more
so the
sense in
book
terms
I
of why
sent
we're
you
doing
for the
what we're doing?
homework, that FAS 141R roadmap, and it had the tax
It's
chapter.
hard to see because this
You know,
feels
if you're
like
interested in this
funny,
topic, if you go back and read this
abstract,
again, my
fake
guess is it'll make more
accounting.
sense after hearing some of the
Something
content in
real,
this class.
right? But accounting is going to...
Anna had sent you out 4 exercises for doing in tonight's class. As you might notice, we did none of them. So you should feel free to do them, and Anna will send you the solutions. I'm not going to require you to do them. You do them if you want. And that'll be the same way we'll do the last 2 classes. Is you want to understand more, you spend the time. You don't, that's up to you, big boys and girls, right? You guys can kind of figure that out.
Right? And the goodwill just...
Okay, for next class,
every financial reporting period...
so next class we're going to do interim
goodwill.
provisions.
So it does what people will call...
And
impairment testing.
so interim provisions are synonymous with quarterly
Very
provisions.
rarely do you see goodwill impairments, but you see them from time
So
to time.
every class, well, for the most part, I've been having you read sections out of our Deloitte provision book. So I'm going to have you read section 9. Section 9 is entirely on quarterly provisions. Okay? Section 9 is pretty long.
Company values are pretty high.
So I would guess it's something like 40, 50
You only
pages.
see them when a company's equity value...
So read it with the goal of understanding the basics, right? I didn't go through and get the specific paragraph numbers because you guys can kind of tell, I think, when you're getting into esoteric stuff. So if you're getting into esoteric stuff, don't worry about it. Read it so you can come to class and understand a little ahead of time so that the class actually gels better.
300 in this example was some huge number,
Honestly, you spend as much time as you want, but that is a get out of it what you put in sort of
right?
thing.
And so
Okay.
they're looking at that transaction and they're saying, nah,
So,
let's not be
read
worth
section
what it's
9.
worth, because our whole company...
Okay, so the next thing I want you to do is I want you to identify, and this is something I want you to turn in, identify 3 public companies.
And they basically said...
Schedule out their Q1, 2, and 3 ETRs.
It's not really
And if
bad.
you identify a company that has not had their Q1, 2, and 3 recently, go to their last fiscal year. I don't care that it's current.
The whole impairment analysis,
Okay,
they came
find a
up
company,
with
find their Q1, Q2, and Q3,
example of one that
10 Qs, and figure out what their effective tax rate is each
The
quarter.
time to see it is when a company's stock
Okay.
has crashed, because that means their value...
Then write me
is
something
value
with
of their
words
assets.
using paper and a pencil.
So that's a simple...
Write based on those disclosures why the rates differ from period to period. Okay? So, none of these 3 companies should be Yahoo, because you're going to read about them anyways.
Concept of an impairment.
So if I was
Concept only.
reading Yahoo, though, I would say, oh, I'm going to pick up their Q1, 2, and 3 Qs.
Constantly prove you
I'm
have
going to
at
look
least
at their tax
720
footnotes and the
goodwill.
MD&A language related
You
to
think you have
taxes.
820 of goodwill?
And I'm going
You
to
need
say, well, what
720
was their
of
effective
goodwill.
tax rate each quarter? And I'm going to see if they tell me why it's different. Okay?
Okay.
So if it went from 32% to 28% up to 46%, I'm going to be like, why? Right?
Can we use the same industry?
Can you use the same? You can identify 3 public companies. Yeah.
But they give us, on the Q, is they give us the
What
the,
the accounting guys
breakdown of
basically
the
do is
taxes
they look at your
are.
business and they
They
divide
show
it
us,
up into
this is
what's called reporting
income
units.
tax, and these are the,
And so
for the
a
pieces.
company like a Zynga might
They do
have
that, if I recall
multiple
correctly, don't
reporting
they?
units.
They do not do that.
Like the US is one unit.
Companies in their Qs, right? You guys have only looked at annual 10K disclosures. Q disclosures are different.
Like they divide up their
They are
business,
much more limited.
hire a firm to go
Okay?
and say, based on what our company
So
reports,
when you read a
how
Q,
you allocate it.
sometimes they're so limited you can rarely tell what's going on. Okay? And by looking at 3, you'll probably get a sense for the amount of granularity companies go through in their disclosures.
I gave a whole like hour
One company I would highly suggest you look at is Amazon.
I can send you my slides.
Their rate is all over the place.
It's a little hard
Okay.
to pick up the adjustments.
And it's not too
Okay.
difficult to understand why, but it's an
So
interesting,
again, I want you to appreciate
very,
why
for
we
such
do
a
what we do.
for a company that's that large,
You think ahead,
their tax
you
rate
think
is all over the
future,
place.
you
It's
need
very
to-
unstable,
Otherwise, you have problems.
right? If you look at like Intuit, by example, their
Okay,
rate is
so
very
now we're gonna
stable,
go into
right? I
a
mean,
bunch
it's
of
just peanut butter.
specifics. And hopefully
But I want you to
see
understand why it's
so far
different.
in
Why
this
is it
class
bouncing
that
around? Why is it
just
stable?
trying to
Like, what's
introduce
causing
you to
that?
the topics.
And write
Okay,
on a
so
piece of
hopefully we
paper
get
with
24
pencil and
hours from now,
words,
you're not gonna remember
in
it,
something
but
like,
maybe it would be a problem.
if your boss was trying to understand, well, why is my competitor's rates stable or volatile? Write me something in the page that explains it. Okay?
Or do I want to know more? Now I can go back and read that.
Okay,
book
and then the
again
last
that I
thing
sent
is
you
read the
and
Yahoo
let me
10K, or, sorry, not 10K, 10Qs. I wrote 10K, but if you come asking him
Okay,
about
so
his K,
goodwill,
that's going to be
in-process
bad, because we're here to
R&D,
talk about Qs
contingent
next week.
consideration, these things can all be
Okay?
tricky.
So read the
And
Qs.
earlier,
I think
we
they
touched on
just
goodwill,
filed their
and I showed you in the
10Q.
example that books called
Anna
out
or Ellen, do you
goodwill,
guys know
tax
if
had no
they
basis,
filed?
yet we didn't do anything with it, right?
I know it's been
So
done
we're
for a
gonna
while.
talk about that next.
Well, anyways, I'm pretty sure it's
For
filed.
both purposes,
Um,
goodwill is just excess purchase price.
And the
Whatever you paid,
third
less
quarter
whatever
Q is
you
very interesting,
bought
so there
in
should be
terms of
lots to talk
identifiable
about.
assets, whatever the
And so
excess
come
is, that's
prepared
what it
to ask Don questions.
So goodwill is
okay?
not in and of itself.
So I think Don has his agenda for you, but I want you to have good questions about
For tax purposes,
quarterly
goodwill may
provisions
or may not be amortized
and know that
over
when you're
time,
talking to him,
right? So back
a
to
lot
our
of what he
confusing
spends his
lingo,
time
if I buy
focusing
the
on
stock
is
of a
how do I
company,
communicate
it has no
what's
inside
happening,
basis of
not just
assets.
not just what the answer
And I don't
is,
get
but
any
how do I
tax basis
communicate
of
it?
goodwill.
Because at Yahoo, when you
However,
see the
if I buy the
10Q for
assets of a
Q3,
company,
you will know that the
and
board cared, the
pay that
CEO cared, the
$1,500 in that
CFO
example,
cared,
the
and so
identifiable assets are
Don
worth
wasn't just
$1,200,
doing
I do
calculations
get
in
tax
Excel
basis
trying to
of
get the
goodwill,
number,
and I can
right?
amortize it over
He was
15
sitting there
years.
going, I got to explain to people who are not just non-tax
Whether or not
people,
for
they're
tax
like
purposes I can
non-financial
amortize goodwill
people,
depends upon the structure
what's up with
of
my
the
tax
transaction.
rate, right? And it was
Most
billions of
deals,
dollars.
I can't amortize
And so,
goodwill because I'm only
as
buying
you're
stock.
thinking about what questions to ask him, think about his position as the guy that had to turn all the stuff we're going to learn next week into English for people that had like major ADD, right? I mean, they want the
So,
headline and that's it.
Goodwill will have what people call component 1 and component
Okay,
2.
that's
okay, so if you want
fine.
to walk out of this class sounding like you know what you're talking about, even if you don't,
Have a good night.
this is a good way to say I'm pretty good with purchase accounting.